27, the one of cash flow, 27, because I rather start with cash flows so that if the time is not on our side, at least we managed to do all the questions, because last week we did the question on the normal consolidation. So this one will be on the cash flow. So the cash flow question 27 is found on page 61 of the tutorial letter. I assume everyone page or went to the page 61. Are we there on page 61? Racing rocket.
Yes, Meneer.
Okay, let's hear what is the racing rocket gonna do for us. We hope we're gonna reach the sky with this rocket. Okay, we've got the racing rocket. For the following information is for racing rocket for the year ended 29 February. So we've got two financial year, 2011 and 2012. So we are given the pre-adjustment trial balance. So based on this question, we just know we do cash flow. But if it was an exam, you first have to go to your required and check what does this person want from you. On the required, we found that this guy is looking for the cash flow from operating activities and cash flow from investing activities. The same two cash flows or phases which Moody's doesn't want is the one which they are looking here. The operating and the investing for the statement of cash flow of Racing Rocket for the year ended 29 February 2012, after correcting and adjusting for all entries mentioned above, the indirect method must be used. So Moody's, if it was an exam, now Moody's was in trouble. So let's see. So Moody's will be scratching his head like, oh gosh, I can't make it. So let's try to push it so that now you'll understand. We've got the debit and the credit on page 61. Page 62, we've got the statement of profit and loss for both balances, the 2011 and the 2012. Then we've got additional information. Now let's read this additional information. They say during the year, Racing Rocket Limited executed an aggressive strategy to expand its operation. Additional land and building as well as plant and equipment were acquired. No land and building were sold during the current year. In order to fund its growth strategy, a loan was taken out on 1 March 2011. Only interest was payable in the first year. So the loan is taken on 1 March, the interest is paid on the first year. So the first day we'll assume is from 1 March 2011 to 28 February or 29 February 2012. Thereafter, 4 equal annual payments of capital and interest are due, starting on 28 February 2013. The loan from the previous year was fully settled during the current year. Interest did not qualify for capitalization. So also those things that interest qualify for capitalization or does not qualify for capitalization, you must also know them so that you don't get confused. But I will tell you later when they say qualify for capitalization versus not qualify, how do you tackle it in a form of a calculation? Number 2, the debenture were also redeemed at par on 30 June 2011. Number 3, the company sold 2 items of plant and machinery during the year and replaced them with the machinery costing 115,000. The first machine with an original cost price of 45,000 was sold for 30,000 rand, incurring a loss of 5,000. A further loss was incurred on the sale of second machine, which had original cost price of 38,000. The balance of the machinery acquired was to expand the company operations. Number 4, the company directors realized that they had surplus space available after the further acquisition of the land and building and decided to lease the extra office space at 7,500 per month, payable in advance, with effect from 1 May 2011. They did not communicate this to the accountant, Mr. Space Out. He posted all rental receipts to the revenue account. The entry has not been corrected yet. So that thing of Mr. Space Out, he's posted all rental receipts for the revenue account, underline that part. the entry has not been recorded. You must also underline that part. The tenant defaulted on the payments due on 1 February 2012 and only paid on 2 March. Also underline that statement. This entry has not been accounted for in the accounting records to date. You must also underline that the entry has not been accounted for. The company treated this as an operating lease. Number 5, Mr. Space Out was unaware that he had been additional rates payable as a result of the additional land and building acquired on 1 March 2011. He received a final demand on 15 February 2012 to pay an amount of 12,000 on or before 31 March 2012. No entries have been made in the accounting records in this regard to date. Number 6, trade payables at 29 February 2012 included a provision of a bonus of 10,000 for Mr. Space Out, which the directors decided to reverse. They informed him on this at his performance appraisal on 1 February 2012, but he has not processed this adjustment to date. An interim ordinary dividend of 10 cents per share was paid on 31 August 2011 when there were 200,000 ordinary shares in issue. On 31 January 2012, a further 50,000 ordinary shares were issued for 50,000, but Mr. Space Out posted these receipts to the revenue account. In view for the anticipated decrease in forecasted profits, the directors decided to reduce the final dividend per share by 60% of the interim dividend per share. They officially declared the dividend on 4 February 2012, and Mr. Space Out did not provide for this. This company financial assets are held for trading as there's the intention of short-term profit taking as part of the business model. So now we're going to go to our solution. So I'm going to share the Excel as usual, then you will notify me when you see it. Okay, notify me. Can you see my Excel now? Confirmation from one of you.
Yes, Mania.
Okay. Now let's see. Question 27. Cash flow statement, and we are required to do it using the indirect. So with indirect method, you know there's a procedure that we need to follow. So the indirect method, we're gonna start by showing you have to first account for profit before tax. So your profit before tax need to be adjusted because remember here we are dealing with a cash flow. So we only focus on things that involve cash only, like cash from, like it can be touchable cash, like we can assume that that cash you can touch it. So in case of the indirect method, when we check, because the indirect have to be started with a profit before tax. Your profit before tax, normally it accounted things that they don't involve cash, like the things like your depreciation. You can't associate a physical cash with depreciation. We just know the asset depreciate, which is an expense, but I can't associate that expense with a physical cash. There is no physical cash attached there. So I have to reverse that so that only things involving the physical cash will take them into the cash flow. The things like finance charges, you know that we pay interest expenses, but you can't attach the physical cash towards the interest. The profit on sale of assets versus the loss on sale of the assets. There is movement of cash involved there, but there is no physical cash that you can associate with that movement. So as if you made an investment, then they said the investment generated a profit or it generated a loss. The loss or the profit on such investment, there is no physical cash that you can attach to. So Moody's say as you battle with the indirect method. The indirect method, you have to start with the profit before tax, and you make adjustments for things that were taken when we were calculating profit before tax, which they are non-cash items, the likes of the depreciation, the likes of finance charges, the likes of can someone admit whoever's joining, because I can't go back to the screen?
Yeah,
The likes,
I just admitted.
okay, thank you. The likes of the investment. So you have to make that adjustment for those movements. So you've got profit after profit before tax, which is they've taken everything, all the expenses they've been taken. But out of those expenses, there are the ones which they don't involve cash. So the one which you don't involve cash, they are the one which you're gonna use them to adjust for your operating activities. So in most cases, there will be depreciation. There will be, gosh, depreciation. There will be finance charges, the likes of finance charges, the likes of loss or profit on sale of asset, the likes of investment income or losses. So these are the first things to do. Those are the first category that you have to do. And then after, there will be the changes in working capital. In working capital, which normally it affect the accrued expenses or income. It affects the prepaid expenses. It affects the inventories. It affects the trade receivables. It also affects the trade payables. So these are the non-cash, the change in working capital. Then after that, then it's where you're gonna get your net cash generated from operations. So let's have a look on this question. So this question, they want us to do a cash flow using the indirect method. So for the fact that they said you must do the indirect method, just know you're gonna start with a profit before tax. That's the standard line. So we're gonna say cash flow from operating activities. And you know the rules. Now, if I'm doing something that you don't understand, you are allowed to pause me. Say, okay, I don't understand. Please clarify this before I proceed. Because sometimes when I'm asking the question at the end, you find that you didn't understand from, let's say you were still on cash flow from operating activities. Then when I'm starting to ask the question is, we are now on the investing. So you want us to go back to the operating, because from that time you were not even following what we were doing. So the minute you start not understand, please notify me. You can just start talking, because from my side I won't see the hands, because since I'm sharing the screen. The cash flow from operating activities. So we're going to start with profit before tax. That's the first line to start with. So in most cases, it will be given. If it's not given, then you have to calculate it. So if you can check, there are certain errors which this person have done, Mr. Spaced Out. So now you have to correct those errors. So it means we're gonna have to do the calculation for profit before tax. So this side, and this will be rename. It's gonna be cash flow. And then this one will be the calculation. Then on the calculation, we're gonna have calculation 1. Which will be the one for profit before tax. So let's see, we've got the profit before tax given. So the profit before tax given amount to 66875. 66875. So now we have to adjust whatever need to be adjusted based on the information given. We are told that on adjustment number 1, nothing to be adjusted there. Number 2, nothing. Number 3, the loss and the profit, we'll adjust it later. Number 4. Yeah, adjustment number 4, let's read it. If you read, they say the company directly decided to realize that they had surplus on the space available after the further acquisition of the land. And then they decided to lease the extra office space for 7.5 per month, payable in advance with effect from 1 May. They did not communicate this to the accountant. Mr. Space Out, he posted all rental receipts to the revenue account. So we've got rental receipts that were paid. So those rental receipts which were paid, the ANA account went to the revenue account, in which they must not supposed to go there. And then they put into the revenue account. The entry has not been corrected yet. The tenant defaulted on the payment due on 1 February 2012 and only paid on 2 March. This entry has not been accounted for in the accounting records. So there was a default payment which is not yet accounted for. So that default payment, we need to account it. So since it's default, on our side, it's gonna be as an accrued income. So we have to adjust this and have the accrued income because it's there, but the account didn't put it in. So we have to do accrued income. Because we are supposed to get this amount on 1 February. However, we didn't get it on 1 February. Instead, they paid on 2 March. So when they paid on 2 March, so it's gonna go back and affect the last year, which is already closed. So on our current year, we have to adjust this and accrued income. We have to record it so that is the profit that we should have at the end of the year, including the ever amount which is not yet paid. So our accrued income will be that 1 month rental which is not yet paid. And then since it's an income, we have to add it. Are we happy there? Silence means everyone is fine. Then that was adjustment number 4. Then we go further. They say on adjustment number 6. Okay, let's go to adjustment number 5. Mr. Space Out was unaware that he had been additional rates payable as a result of the additional land and building acquired. On 1 March 2011, he received a final demand on 15 February 2012 to pay an amount of 12,000 on or before 31 March 2012 to entries. The entries have been made in the account records no entries have been made in the account record in this regard. So now we have to account that amount of accrued rates. There are rates that we need to pay by end of this financial year, which Mr. Space House did not pay them. So we have to account them. So we're going to have accrued expenses. accrued expenses of how much? The 12,000. So the 12,000 is an expense. It needs to be in a bracket. Brackets. Cool. And then we have adjustment number 6. The trade payables at 29 February 2012 included a provision of a bonus of 10,000 for Mr. Space Out, which the directors decided to reverse. They informed him of this at his performance appraisal on 1 February 2012, but he has not processed this adjustment to date. So Mr. Space Out, they made a provision. So the minute they made a provision, it was recorded in the trade payables. So it's an expense that we're gonna pay the 10,000 to Mr. Space Out as a bonus. But since Mr. Space Out, they're no longer gonna pay that bonus, that provision must be reversed. So the provision when it's being reversed, so it's gonna generate cash back to us. So that cash, it will be represented as an income in our books. So we will record this as a income for this reversal of the bonus. So bonus reversal, and Mr. Space Out. It will be an amount of how much? 10,000. So this 10,000 will be an income to us. And then lastly, we've got adjustment number 7. An interim ordinary dividend of 10 cents per share was paid on 31 August 2011, when there were 200,000 ordinary shares in issue. On 31 January 2012, a further 50,000 ordinary shares were issued for 50,000. But Mr. Space Out posted this receipt to the revenue account. Yo, hi, Mr. Space Out, now you busy. Mr. Space Out, instead of posting this into the share capital, he posted into the revenue. So it means Mr. Space Out increased our revenue account with further amount of 50,000. So it means our profit is increased. So we have to reduce this profit of that we have with a further amount of 50,000. So we're gonna say proceeds on shares so the shares were included in our revenue account. So it means they increased the profit. So now we have to remember, the higher the revenue, the higher the profit we get. So now we have to reduce this profit that we have by a further amount of 50,000. So now we have to calculate our profit before tax. So this is after adjustment. So this is adjustment of whatever things that done by Mr. Space Out. So this is adjustment of the entry. So if let's say you are given a profit before tax without any adjustment, everything was correctly recorded, you're just gonna take that profit before tax and you plug it in your statement of cash flow. But in this case, because we have a accountant which was not recording things correctly, we first have to adjust our profit before tax. After we adjust our profit before tax, then we have a correct profit before tax. Then after we transfer it into our statement of cash flow. Corrected profit before tax. So which it will be, let's add all this thing together. We've got 66,875. We add it with 7,500.
Can I ask you to explain adjustment number 7 again?
Adjustment number 7, the issue of shares.
Yes.
Okay. We've got, let me do it like this. We've got revenue here. This I'm doing it in the form of ledger so that you can understand it. We've got revenue account, sales on the credit side. Normally, let's say it's 150,000. Then on the date, 31 August, on the date, 31 January, the company issues shares. So here we have capital. We've got a balance brought down, which is ordinary, is based on the ordinary shares. So it's balance. And B brought down, B/D, which is 250,000. Who was asking the question though?
To me. Takalani.
Takalani, okay. Okay, so TK, based on this ledger, we have the sales 150, we've got the balance brought down of the capital. So on the 31 January, the company issues 50,000 shares. Based on your knowledge, where should these shares be recorded between these two accounts? Just use your knowledge. Forget about Mr. Space Out. Or anyone can assist if Takalan maybe is confused.
Mr. Mulibo, what is the question?
We've got shares based on adjustment number 7. They say on 31 January 2012, a further 50,000 ordinary shares were issued for 50,000. Just stop there. Forget about whatever Mr. Space House did. Let's say this is now you as an accountant. We as the company, we issue 50,000 ordinary shares for 50,000 rand. Where are you going to record these shares? I given you 2 accounts, revenue account, capital account.
In the capital account.
Okay. The shares should be recorded on the capital account. So here should be share issued. Is 50,000. Right? So this one is the correct entry. This one is the correct entry, the way they should be recorded. But Mr. Space Out, he decided to record them here on the sales, on the revenue account. So he said share issued is shares issued is 50,000. And let's mark this with red to show that it's wrong. Sorry, this should be in red. It's wrong. So now the revenue or the profit is now sitting at 200,000, right? As per Mr. Space Out. So now let's do our income statement. We're gonna have revenue, which is 200,000. Then we have all the expenses of, let's say, 120,000, for example. So our profit before tax will be how much?
80,000.
80,000.
Yes.
So our profit before tax is now sitting at 80,000, which this profit before tax is wrong because we recorded things that they don't belong here. So now, since we have a profit before tax of 80,000, we need to correct this. So it means our profit before tax was inflated by 50,000. So now we have to record this. That's why we're gonna say from the 80,000 we have, we say less the proceeds. Because now we are correcting the information, right? We're gonna say the proceeds on shares issued. We are listing them because they were incorrectly recorded in the revenue account. Instead, they must go to the share capital. So we have to less the 50,000 that was incorrectly included. Does it make sense?
Yes.
Yes, it does.
So now it means by right, the profit that we're supposed to have is supposed to be 30,000. Is it fine? Because it was supposed to be It was supposed to be 150 minus 120, which is 30,000. not 200 minus 120. That's why we are having this entry. Is it super?
Yes, thank you.
Takalane, are you fine now? Are you totally understanding what was the issue happening here?
Yeah.
All right. So
Thank you.
this is because of Mr. Spaced Out. If you can read all the transaction here, transaction number 5, Mr. Spaced Out did whatever he wanted to do. Transaction number 6, Mr. Spaced House, they told him that you were having a bonus, but because of the work that you are doing, which is not according to the standards, we are reversing your bonus. Instead of even reversing that bonus, he doesn't want to reverse it. They say still on the 1 February, he has not processed that adjustment, even after they told him that this must be reversed because he's just doing the books according to whatever the way he wants. He doesn't reverse things. Even you can check the transaction number, the last one. I think he also did something wrong there besides the 50,000. If you read further, they will say, in the view of the decrease in the forecast profits, the directors decided to reduce the final dividend by 60% of the interim dividend per share. They officially declared on February, and Mr. Space out, okay, this one is the only one which he did correctly, but most of the things he was not doing them correctly. So now we have the corrected profit before tax sitting as we were still calculating. Then Takalan wanted to have a clarity. So let's calculate. We're at 66,875. We add 7,500. We less 12,000. We add 10,000. We less 50,000. So my profit before tax adjusted one is sitting at 22,375. Anyone to verify it?
It's correct.
Okay, 22,375. Cool. Then we proceed. So this is our corrected profit before tax. Then this corrected profit before tax, it can be transferred into our cash flow as profit before tax. Then you will say calculation 1 to show the marker. And again, for those, I don't think there's one who did FAC2601 with me here. For these modules, the minute you start calculating this, transfer it here and say calculation 1. You must tell us that this comes from calculation 1. Calculation 1, and then the amount that you got, you said is 22,375. If you say profit before tax is 22,375, and you don't tell us this is calculation 1, suppose if it's correct, you will be like, suppose your 22,375 was not correct, then you were gonna lose this max. The reason being, let's say instead of putting 50,000, you put 40,000. As a result, your profit before tax was gonna be wrong. And that side you didn't see is calculation 1. You find that here maybe it's 1 mark, and then here maybe it's 2 marks, and then here maybe it's another 2 marks, and then here is 1. They know that this thing, it contributes 6 marks here. By saying profit before tax, correct amount, you get 6 marks here. They will put 6. But the minute this amount is wrong, they no longer focus here. Now they're going to go to the calculation 1 and see what was happening in calculation 1. Then we go to your calculation 1 and we see that, okay, you got this one correct, you got this one correct, you got this one correct, but this one is wrong. Then as a result of this wrong, then you, out of 6 marks, you only collected 5. But suppose you didn't tell us that this is calculation 1. That 5 marks that we were supposed to get it from here, you're going to get 0. Are we clear?
Yes.
With the marking system.
Okay.
So
Yeah.
it's important to show this come from calculation 1. Suppose here you put 21,375, which is wrong. Instead of getting 6, now we'll say, he got this calculation wrong. But since he told us this calculation 1, let's go to his calculation 1 and see what was happening. Then we see that, oh, in calculation 1, he messed up with the proceeds on shares, whatever. You either you included them or you didn't include them, or you put the wrong amount, or everything is correct here. It's just when you were calculating, because when you calculate his own speed, then we see that he just messed up with the calculation. Maybe he pressed one button by mistake. It's just a finger error. But the calculation you can see is correct. you still scoop this, you still scoop the whole 6 marks, even though your amount that side was wrong because of your punching error. But if you didn't tell us that this is from calculation 1, then you're gonna just get 0. And they don't have grace. Even then, when they're busy marking, then they see that, oh, this calculation 1 for profit before tax. But for the fact that you didn't reference it, you just get 0. It's your punishment. Ne? So let's proceed. So we calculated our profit before tax, the adjusted one. Then we see it's 22,375. Then we put our 22,375 here. Now, Mulise, are you still fine up to so far?
Yes, yes, I'm good.
So,
that's one of the questions I was going to ask, especially with regards to marking, because you never get everything 100% in accounting. So
yes, in accounting, you don't get anything 100%. However, it's important for you to reference. You do something on calculation, reference as that this comes from calculation number 2B or come to calculation number 3C. And in accounting, especially that time when they were still writing in the exam center, they were not having a problem with us showing this in highlighters. Like I saw, okay, this is highlighters in yellow, this one is in green. So if I go that side, I make profit before tax calculation 1, then I put this in green amount. So when they go there, they say, oh, this green amount comes from this illustration. So they will mark. But if you don't reference, then you will get 0, especially with accounting, especially the 2601 and the accounting third level. The third level, they don't even compromise. You don't reference, you get 0. You start with calculation, you don't transfer the information into the financial statement. The whole financial statement, you get 0, even though you have done all the calculations, because we mark from the main to the calculation, not from the calculation to the main. Are we clear?
yeah. Okay.
So the marking process, we start from the main going to the calculation. So if the amount is wrong on the main, but you reference to the calculations, then we're going to focus on the calculation. Then we see how much out of that 10 marks you can able to score. Out of the 10 that you managed to score 7, because you told me that my this question, I mean this profit before tax, it comes from calculation number 7. So when I get to calculation number 7, I see what you did wrong. So let's proceed. So we have the cash profit before tax on calculation 1 is 22,375. Now we have our calculate the corrected profit before tax. Now we can start doing the adjustments. So this now we have to focus on things which they don't involve cash, but they need to be taken out, like things that they were taken in account when we are doing the profit before tax, which they were not supposed to, as they don't contribute cash. Because remember, we are focusing on cash item. So things that I've marked in blue here, now they have to fit here. It will be the adjustment for. So you're gonna say adjustment for. So whatever I marked in blue, it must now come this side. I said there is a depreciation. So the depreciation, so which amount of depreciation are we gonna use from our statements? We've got the accumulated depreciation. We've got the depreciation itself on the statement of profit and loss. Which one are we gonna use? Anyone to try? Anyone? None.
Melia, what is the question?
Are you listening, guys? Hi, I'm getting worried.
We are listening, but in between you have a question.
My question is, which depreciation are we gonna use between the amount shown in the statement of profit and loss and the amount shown in the statement of financial position? Which amount are we gonna use as a depreciation? That's the question.
Okay. Thank you. We're gonna look now.
30
Okay,
seconds.
Can I try?
Yeah.
We'll use the one in the statement of profits and loss for this year, which is 2012, the 115.
So we're gonna use the 115.
Yes.
That's true. We use the 115. So we're gonna say adjustment for, then we put 115 here. So Nokubonga, in a normal circumstances, depreciation is an expense, right?
Yes.
So based on the adjustment for this cash flow, how am I going to record this adjustment? Am I going to record it as a plus? Am I going to record it as a minus?
I think it's a non-cash, right? So we have to take it out of the profit, isn't it?
Okay, Nokubonga said we have to take it out of the profit. So my Nokubonga, if you say we have to take it out of the profit, however, it was already it's already taken out here. Remember, the 66875 is the amount as profit.
Oh, yes. Now I have to add it back to the profits because it was out because it's an expense.
Thank you. So if it's an expense, when you're doing the adjustment, if it's an expense, you have to add it back. If it's an income, you have to minus.
All
so
right.
you are doing the reversal. So these things in the box, you have to do the reversal.
Okay.
Say, are you copying?
Yeah, I think that's the part that was confusing me as well.
Okay.
Yeah.
So this, they have to be in the form of reversal. Like this. So Moody said you have to make this in a reversal so that you don't get confused. So if they given the non-cash items, things which they taken into the statement of profit and loss as an expense, as an income, but they don't necessarily make cash. It's not cash, like you can't touch them as a cash. There's no cash attached to them. Those things, when you do the adjustment, you do them in the form of a reversal. If it's on an expense, you add it. If it was an income, you subtract it. So Nokubonga told us the depreciation, since it's an expense, now you have to add it back. Thank you, Nokubonga. Then we proceed. The next things to look at, it will be, let's go to the finance charges. Finance charges. The finance charges, which one are we going to take? Let's see, randomly selection, it will pick who. We pick Mary. Mary?
Hi, sir.
The finance charges that we're going to use for the adjustment of our cash flow, which one are we going to use? The amount?
72125.
The 72125. So our 72125, which is for an expense, we have to add it back.
Yes.
Okay. And then another amount, let's go to investment income. So things that are cash, that are expenses or income, but they are not in the form of cash. They are the one that we do adjustments for. So investment income, we've got amount of 15,000. So we're gonna put the 15,000 here. So the 15,000, how should be accounted for? The question must be posed to Glenn Rose.
I'm in here. Is the question on investment income or loss on sale?
On investment income. How must I record that investment income? The 15,000. Plus, minus.
As a plus. No, as you less it.
The reason being?
Adjustment number, can I please go back?
Okay, you go back where you want to refer us. We will be waiting for you.
Yes, I must go on the adjustment.
Today, I'm not going to be in a hurry. I want us to understand this cash flow.
Investment.
Which adjustment are you referring us to?
I don't see it on the adjustment.
Okay. The amount is sitting on the statement of profit and loss, the 15,000.
Yes. You want to know the reason why are we lessing it?
Yes, based on you said we have to less it. So now I want to know the reason. Because I don't want you to use the framework. You don't know, you can't write accounting framework. Okay, in example 7, they less it. Mamutla must also less it. What if now I have to edit?
Can you assist me which adjustment it is?
It doesn't have adjustment at all. It doesn't have adjustment. It's just the amount sitting on the statement of profit and loss is 15,000 income.
So you want to know why it must be lessened?
And if you listened to Nogubonga,
okay, you know why
she already answered that question. So I think it was gonna be easier for you to answer
yes,
it also.
Yes, you know why it must be lessons, because it says dividend on investments. So maybe it's an expense we must less it out because it's being paid out to the dividends.
Anyone who gets this statement? Mary, do you follow Glenrose?
I think Glenrose is a bit confused.
Yeah, I am.
Okay, Glenrose, Mr. Mulepo and Nokubonga, they've explained, Barry, ne? If we are having the expenses, like for example, a depreciation is an expense on its own. But then when we are doing the cash flow under the adjustment for, you have to add it back.
Because it's an
and then
expense.
if you have an income, when you're doing the adjustment on your cash flow, then you have to subtract it. You just do the reversal.
Because it's a non-cash item.
Okay, understood. Thank you.
Okay.
Okay.
At least it was better for me, for my pointer to choose you, because I'm just choosing randomly. So I think my pointer to choose you so that you can understand. Even if when it comes on Tuesday, it will ring in the bell in your mind that this was there on Saturday.
No,
so we put 15,000, and then our 15,000 must sit as minus because it was already included as an income in the profit before tax. So we put minus 15,000. Then the last item to be taken is the loss or the profit on sale. So now let's check adjustment number 3. The company sold 2 items of plant and machinery during the year and replaced them with the machinery costing 115,000. That's the replacement of the machine. The first machine with an original cost price of 45,000 was sold for 30,000, incurring a loss of 5,000. Then a further loss was incurred on the sale of the second machinery, which had originally cost price of 38,000. The balance of the machinery acquired was to expand the company operation. Now we have to calculate. Already they told us there is a loss. They already told us there is a loss on sale of an asset. So now we have to calculate this amount of the loss. They given the loss for the first asset at 5,000. Now, what is the loss for the second asset, which we don't know? We have to calculate it. So let's do the calculation of the loss. So the loss on sale of assets. So we have to have asset 1 and asset 2. Just hold on for a minute. Then hold on for a second. I will be with you. Okay, I'm back now. So we're gonna calculate the profit before or the loss, which in this case will be the loss expense on sale of an asset because we already told. So loss on sale of asset. So we've got asset 1 given the loss itself, asset 1 or the machinery number 1. The loss is given as the loss given is they said the loss will be 5,000. So now let's focus on the second loss. So the second asset, they said it had a cost price. So now we do asset number 2. Asset number 2. Asset number 2. The cost price of it. Cost price. The cost price is sitting at 38,000. Now we don't know the carrying amount of it because we don't know how much it was valued and how much loss did we do. So now we have to do another further calculation. So a further calculation will be done in the form of ledger, which it will be the one involving the plant and equipment at cost together with the accumulated depreciation. So we have to do all these 2 calculations all together. So first, we're going to start with so this, let me box them in the meantime. So we're going to have the plant and equipment. So we have, remember, in most cases, when we do our calculation, we do them in the form of a ledger. So we're going to have a plant and equipment. So we got the debit. And we have the credits. So remember, the plant and equipment, they have the debit balance. So it will be the balance brought down. The balance brought down. So the balance brought down, it will be the amount which is sitting when we check our statement of financial position. For plant and equipment, we have the amount of 225. You see the amount of 225 on the 2011.
Yes.
So that will be our balance brought down because remember what we close off today, we're going to open with it tomorrow. So we closed off on 2011 on 28 February. So on 1 March 2012, when you open, we'll open with 225. I hope I make sense there. So that will be our balance brought down. So now we have to check what happened during the year, the current year. The current year, so this is at cost. Remember, it's plant and equipment at cost. So we have 225. So what happened during the year? They said they bought something. Adjustment number 3. During the year, the machinery was replaced for 150. Do we see? Adjustment number 3. Anyone to acknowledge before my point of selecting someone?
Yes, sir. We can see it.
The replacement is 115. And then, and we know that is an addition. So the addition must be added on the debit side. Now we sell. When we sell, we are decreasing this asset because we are reducing it. So the sales at cost for the first machine. So the first machine sold. The first machine sold, it was sold for how much? At cost. I will ask, you see, I will ask Takalani.
Okay, on the adjustment number 3, it says was sold for 30,000.
The 30,000 is the selling price, and here we are dealing at cost.
Oh, at cost. It says 40. The cost price is 45,000.
45,000, correct. Then the sale of the second machine.
They did not say original cost was 38,000. Okay, it's not said here on the second one.
So it's 38,000, right? Are we happy, all of us? Beside Takalani, are we happy?
Yes.
May I please ask something? So when we're doing this kind of calculation, we normally use at carrying amount. Can you please explain why are we using at cost this time? I know we were not given carrying amounts. That's why I got confused when doing this.
Yeah,
so what is the difference?
The reason now we are using at cost is because we are not given the carrying amount, all of them. Some they are not given carrying amounts, so we have to use the cost. No, you are right. Normally we use the carrying amounts. So today, because the reason we are using the cost part is because we are not given the carrying amount of all the assets. We have to calculate the carrying amount of another asset. Like the sale machine number 2, we don't have the carrying amount. So if we were having the carrying amount, we were gonna determine that carrying amount. We were gonna use this calculation using the carrying amount as you know.
Okay, so let's say for the machine 1, we were giving a carrying amount, and machine 2, we were giving cost. Can you mix them, or you'll still have to calculate the carrying amount of the first one?
Then now you have to calculate it. Remember, the machine 2 is given at cost. The machine 1 is given at carrying amount. It means now you have to calculate the carrying amount of machine 2.
Okay.
Yeah, in order to use the carrying amount calculation.
All right, thank you.
So now we are using the cost because instead of we are given the cost for both machines, but at the end we want to know how much was the carrying amount, because remember, the carrying amount, it is the one which is gonna lead us to calculate the loss.
Yes. Okay, understand. Thank you.
Thank you. Another one who have a similar question towards this? None. Then we proceed. So now we have the sale at cost for machine 1, sale at cost for machine 2. So we add them all together. So when we add them all together, now we are, remember now we have to close the thing. We have to close our machine section. The machine section, when you close it, it tells us the balance carried forward is how much. Remember, it's the one that we're gonna open the 2013 financial year. So the amount that we can close the asset at cost is how much as our balance carry forward? Anyone want to guess?
600.
600. We all agree why we're using the 600, right? Because we opened with 225, so we have to close. If you open, you must also close. So this is the closing part. So this will be the opening next year at balance brought forward 600. Are we happy? Then, by look of eyes, this side is bigger than this one. So this side, when you calculate it, it will be 683,000. So this is 683. Then the total must be 683 both sides because they must be equal at the end. So it means here we're going to have balance. It's not even going to be balanced because remember, this one will be cross further to here. Because this will be total like this. It will be like this. So this one will be balance brought down for the next financial year. So it means on 1/03 2020 is 2012, ne? Yeah, on 1/03 2012, this will be our balancing, our opening balance as 600 for the financial year ending in 2013. So now we have to have a balancing figure here. So the balancing figure will come as a form of further additions. So this will be additions as a balancing figure. So you're gonna say 683 minus this one. They give you how much? 683,000 minus 115 minus 225. Someone must calculate for me.
It's 343,000.
343.
Yeah, 000.
Okay. So we are happy, ne? All of us. So now we have the planned at cost. So now, if the machine is 38,000, so we don't know the carrying amount of this machine because this machine we have the cost, but we don't have the. Now we have to calculate the carrying amount of this machine. So we proceed further. We're gonna do accumulated depreciation, guys. And someone please mute in the meantime. Accumulated depreciation. Accumulated depreciation, we go back. Balance brought down will be on the credit side. So we have balance be brought down. The balance brought down on the accumulated depreciation will be how much?
$110,500.
110,500. That's true. And then during the year we had a depreciation, right? That was written off, which is going to increase our accumulated depreciation. The depreciation we write off during the year is how much? From the statement of profit and loss?
115.
Okay. So on the debit side, we're going to record the accumulated depreciation of the asset sold because it's now gone. ACCC of assets sold because it's decreasing this accumulated depreciation of asset sold. Accumulated depreciation of the assets sold, the first one. Is how much? Can anyone to calculate it? Based on the information adjustment number 3.
Is it 10,000?
10,000. How did you arrive to 10,000?
It was 45,000. It was supposed to be sold for 35.
So you said cost price less 35.
Yes.
So the 35 meaning it will be the 35, you got it as a result of saying the selling price plus the loss incurred. Are we happy there?
Yes.
Is another people following you? I want to check them. Are we following?
I do follow.
Okay.
Me.
Okay, so they follow you. So it means here is 10,000. The 10,000 came as a result of the cost of 45,000. We less the 35,000 carrying value. This asset was the carrying value was 35,000, but instead of selling it 35,000 so that they break even, they sold it for lesser at 30,000 and incur loss of 5,000. I guess it's clear. So here we have 10. We have 10,000. Did someone wanted to say something?
Can I ask? Okay, the way I did it was to work backwards. I just want to understand if I'm correct, because now I'm getting confused when the way you're explaining it.
Okay, let's do your backward. It's fine. Your backward Nokubonga method. It says, I will write it here. Bonga. Okay, let's do our backward. Which one do you start with?
Yes. So I start with we know that the cost is 45. We can put the cost down as 45, right? So to get carrying amount, we must minus the accumulated depreciation. So that's what we're looking for. So when we start down there by the loss, so you can skip lines there. So yes, let's accumulate. We're looking for that. That equals CA carrying amount. We're looking for that. And then proceeds. That's what we have right now. We have proceeds because that's the amount that we sold the machinery for, which is 30,000. So that's 30,000, and the total will be the loss, which is 5,000. We have that. So to work backwards, I would start with the loss. So now proceeds 30. 5,000 is a minus. So when you work backwards, you add the 5,000 with the 30,000, which gives you the CA, the carrying amount, which is 35,000. So we know that when we minus the accumulated depreciation, we get the CA. So we have to add it to get the 45, which is 10,000. That's how I do it.
It's still correct. As long as you understand the logic, doesn't matter. As long as you understand what minus what must be what. If someone what is not given, what must I do in order to get the other one?
Yes.
No problem. Cool. No stress. Then we are all on the same page. That was the first asset. Now we have to go to the second asset. That was not given. The second asset. So since the second asset is not given, this will be used as a balancing figure. Don't worry much to calculate it. It will be used as a balancing figure. So you have your totals. So your totals will be sitting as you have to check since you opened, you have also closed, right? So when you close, you're gonna close on which side? Anyone to try?
On the debit.
On the debit. Okay, when you close, you're gonna close it on the debit. So it means it's gonna be our balance. Balance be brought. It's not brought down. Balance CF. CF. We're gonna close with the amount of, as shown in the statement of financial position, accumulated depreciation planned is how much? The balance shown on the accumulated depreciation plant and equipment.
209,700.
So it means which side will be bigger?
Left is bigger.
Left is bigger.
It's bigger.
Left is bigger.
100,000 plus 209. It's bigger than 110 plus 150.
This should be 10,000, not 100,000.
Oh, sorry. Okay, that will be like 219 now. This side is going to be 225,500. Credit is bigger.
Credit is bigger by how much? 225.
Yeah.
Okay, 225. Then we say 225 minus 209. Then we get a balancing figure of how much? Balancing figure 225,000. 225,500 minus 10,000 minus 209. It's 500.
225,500.
5,300.
Okay, 225,500. We less 209, right?
Yes.
And then we less 10,000. We get 5,800.
58 or 53. Oh, did I miss the 500? Yes. Okay.
5,800 sharp. Then this will be our balancing figure. It will be our accumulated depreciation for asset number 2. So this accumulated depreciation for asset number 2, now we must go back. We have the cost price is 88,000. Then we less its accumulated depreciation. Then it will give us the carrying value.
Why am I still getting 5,300?
Okay, go accumulated depreciation.
Okay. The two, who is it? Okay,
here,
10,000 plus 209,700. How much is it? Isn't it 219,700?
The what and what?
The 10,000 plus 209.
10,000 plus 209,700. Yes.
Yes.
It's 219,700.
Minus 225,000.
It's 5.3.
It's 5.3.
Yes.
Okay. Then let's see. So we have to go and calculate the asset number 2. So our asset number 2 is gonna be the cost given, which is 38,000, right? Then we less the accumulated depreciation of that asset, right? So we say 38,000 minus, okay, let me push this.
I'm sorry to disturb, please.
No problem, you can disturb anytime.
May you please go back to accumulated depreciation? We are getting 5,300, but I think it should be 5,800. That is because 110,500 plus 115,000 equals 225,500. Here.
Oh, here.
Yes. That's why we got 5.8.
Oh, okay. Now it makes sense. So 225,500.
Yes.
225,500. So it means here's 5.8. Lokubonga.
Yes, it means it's 5.8 because we minus the 209,700 minus 10,000, we get the 5.8, which is the balancing figure, which is our accumulated depreciation.
We are now all happy.
Yes.
Okay, then we calculate the thing. We're going to calculate our, where were we? We're going to calculate this. asset number 2, the cost price is sitting at 38,000. Then I want to add a few lines. So we less accumulated depreciation. If accumulated depreciation as a thingy is 5.8, right? We are happy, right?
Yes.
Then it must be in the brackets. Then the CA is how much?
Where is 5.8?
Where is
5.8.
5.8 is this one. Did you follow the correction? Our correction is here. Here's our correction.
Oh, yes. Oh, yes.
1110,500 plus 115, it will be 225,500. Then the 225,500 less the 209,700 minus 10,000, it will give us the 5,800. Then the 5,800 balancing figure, it was our accumulated depreciation. Now we must less it here as accumulated depreciation for the asset sold itself, which is here.
Okay. I remember now you said it's going to be a balancing figure. Okay, I remember. Thank you.
Okay. Then the cost price minus the cumulative depreciation of the balancing figure, we've had the carry amount of how much? $38 less 5.8. We have 32,200. 32,200. So this is our carrying value. So the asset itself, let's see. Further loss was incurred on the sale of the second machine, which had original cost price of 38,000. The balance on the machinery acquired was to expand the company, whatever. So now we had the carrying amount. Now we want to know how much this asset was sold.
Oh.
You see how these people, they triggered this thing. Now we have to calculate. We want to verify this loss. So now they say, based on the statement of profit and loss. So now we go here. Based on statement of profit and loss. We had total loss given, right? How much was the total loss?
18,725. Sorry.
Yeah, it's 18,000. 18,000, Jay. It's 18,000 straight. Not what 10. The total loss. When you use the amount for income tax expense.
Yeah.
So the total loss is 18,000. We are all happy, right?
Yes.
So now less the loss on asset number 1.
Yes, which is 5.
So the loss on asset number 2 will be how much?
13,000.
Sorry, undo. So the loss, the total here will be 13,000. So the total loss on the asset number 2 will be 13,000. So now, what was the main purpose of doing this horrible calculation that took almost 20 minutes of us? What was the main purpose of doing this question? I mean, where were we, if we remember?
Loss on sale of assets.
So loss on sale of assets. So this thing, even though it was given, it's gonna help us when we are doing the investing and all other things. So the loss on sale of an asset based on the given amount is 18,000. That one is true. But for us doing that calculation, it's going to benefit us when we are doing the investment part, especially, the investing part, because we'll be just taking around this information that we have here, these two ledgers. Are we clear there? So we didn't waste much of the time. We're still going to use the same information that we have here, based on these two ledger accounts. So let me highlight them in no. So the loss on sale of an asset is given as per the information there. If you see from statement of profit and loss, you can just put the 18,000 and which it will be a plus. Then now we have to calculate at these values, which now they give us an amount of 190. Here it says 190. No, sorry, I have to go up to here. So they give me the 212,500. So when you add the profit before tax calculated, you add depreciation, you add finance charges, you less investment income, then you add your profit. I mean, the loss on what, then it will give you the 212,500. Are we following up to so far? This one is given raw as it is. It's just the calculation that we did here was to have the understanding of this accumulated depreciation versus the planned at cost, so that we're going to use this information highlighted in yellow when we are doing with the investing part. Are we happy?
Yes.
So suppose you are not doing those things, you are going to just say loss on sale of an asset 18,000, and from there you proceed. You have your you have the amount, and then you do your changes in working capital. So the changes in working, so is this one now. Now we do the changes in working capital. Please say, are you still fine? The indirect method?
Yes, I'm following things.
Okay. So the changes in working capital is going to involve this. The accrued expenses or income, the prepaid expenses, the inventories, trade and receivable, and trade payables. So now let's start with inventory. Inventory. So inventory, Arona. Now I'm going to ask question. Listen very attentively. We've got inventory amount at the end of the year is 102,000. At the beginning of the year is 130,000. So inventory, did it increase or did it decrease? This is the question. Anyone to answer before the pointer goes to someone? Anyone to answer? Okay. Let's see. We choose Mary. Mary, our inventory, it was sitting in the beginning of the year, it was sitting on 130. Now it's sitting on 102. Is it increase or decrease?
It's a decrease.
Okay. Mary said it's a decrease in inventory. Okay, thank you, Mary. Decrease in inventory. Now the question goes to Glen Rose. Since the decrease in inventory, what's happening to our cash? Do we have cash coming in? Do we have cash going out? Glenn?
It's cash coming out.
Glenn said it's cash coming out. Let me check with Mulise.
If okay, the inventory is increasing, right? So
the inventory is decreasing.
It's decreasing. Okay, it's cash coming in.
Mulise said it's cash coming in. Okay, let's see. Mulise in, Glenn out. I want this class to be, it can be entertaining, it's fine, but I want you to remember these things when you'll be writing on Tuesday. You have to remember this entertainment that we had today. So Let's see. Glenn will set out, né?
Yes.
Now I'm gonna ask this. Just a question will be
it's general knowledge.
Yeah, now I'm gonna ask the question in a very simple terms. Now let's make it a reality. You are having your own spaza shop. Né?
Okay.
So having your own spaza shop, you had inventory of 12,000 at the beginning of the year. And now at the end of the year, you have inventory of 10,000. So it means your inventory was going out.
Yes.
So if your inventory was going out, what happened to cash? Now cash.
Comes in.
The cash was coming in because people, they were doing what?
They were buying.
My inventory. It makes sense, right?
Yes.
So now the decrease in inventory, we're gonna generate a cash inflow.
Okay.
Is it happy to everyone?
Yes.
Okay. So the cash inflow here night over how much? Now let's calculate it. We had the balance at the beginning of the year. So normally they're not gonna say balance at the beginning of the year 102 minus 130. We just put them as 130 minus and we put the balance as the way they ask. In the beginning of the year, our balance was how much? It was 130, right? So we say 130, then we less the 102. So we have a 28,000. Is it 28,000? Yes. So we have a 28,000. That will be our cash flow, the cash coming in, because people at our community, they were buying the inventory or they were buying our stock. They were not looting. We happy? Are we happy? Now I want to use the same information. Suppose now, since they got magic out of nowhere, they said, we had an inventory of 130,000, but at the end of the year, the inventory is sitting at 102. The inventory was sitting at 102 as a result of the community came and steal the inventory from our warehouse. Then how was going to be the cash in this case? Cash inflow, cash outflow. You were coming right now. Now you get confused.
Can you repeat again, Minia?
Okay. The question is, we had an inventory to the value of 130,000 at the beginning of the year. Now at the end of the year, our inventory is sitting at 102. But the reason inventory is sitting at 102 is because our community members, they broke up in our warehouses and they steal inventory or they loot the inventory, like what happened in July. So in terms of cash, are we having cash in movement as in, or are we having cash movement as out? The inventory was looted.
That's a non-cash item because we didn't use my.
Okay. Someone is non-cash item. Another one said what?
I said it's a loss. So it's a loss of sales.
It's a loss of sales. Another trial, the last one. Another one to try.
I would say it's an outflow, cash outflow, because the cash didn't come in.
It's fine. Just stop there. Now we have 3 scenarios. We've got Nokubonga, which he said is outflow. And then we had the one who said it's a loss on sale. Gimang.
Glen Rose.
Loss on sale is Glen. And then the other one said is what? Someone said something, the last one.
Takalani.
Okay, Takalani. You said is?
Non-cash item.
Non-cash item.
Cash item. So Glen Rose and Takalani, they are on the right track. The reason being, no inventory was sold. So since there is no inventory sold, it generated a loss on sale of the asset. So as generated a loss of sale asset, which it was the loss on sale of an asset is gonna be what? Non-cash item. So this is gonna affect this portion here. the looting of inventory is gonna affect here. Is it clear?
Yes.
All right. So this things, like when things happen in our spheres of life, also take them into the business context. Like the people which they had the losses of in their assets or the inventories during those unrest, you have to now ask yourself, how did they treat those movement of the stock? So they treat them as a loss of sale of an asset, which is a non-cash item. So they will be put as an adjustment for when they will be closing their 2021 financial year. They will be put as an adjustment. The same applies to suppose it was in terms of the management accounting. Then they're gonna be the loss on inventory. So it's either as a result of a spoilage or what. So you have to link this information happening in our life into our books. The same can go further into the audit. When you audit that inventory which was lost, how do you audit it? For those which are doing the audit, then 602, now they can say draft the substantive procedure to audit the loss of inventory. How are you gonna do it? So it's just a general knowledge. So now let's proceed. Now we had a decrease in inventory. As a result, it generated a cash inflow. Then let's go further. We're gonna have the trade and other receivables. So let's put here as a trade and other receivables. The trade and other receivables in the beginning of the year, it was shown as how much?
43,000.
43,000. And then what happened during the year? Did something happen during the year that do you think it might be attached to the trade receivables? Adjustment number 3, nothing. Adjustment number 4, adjustment number 5, no. Adjustment number 6, no. Adjustment number 7, no. Then adjustment number 5 is gonna affect our trade receivables. Why? The office space here 7,500. What happened? Let's read that information. They say the company has realized that they had the surplus available for further acquisition of land and decided to lease the extra by 7.5. So month payable in advance with effect from 1 May 2011. They did not communicate this to accountant Mr. Space out. He posted all rental receipts to the revenue account. The entry has not been corrected yet, and the tenant defaulted on the payment due on 1 February. Trade receivable, we are having amount which is due to us. We have to receive the 7.5 from our tenant who defaulted. Are we happy there? Hello?
Yes.
Are we happy?
Yes.
So we have to edit that default. We have to edit. We have plus 7,500. So our closing balance is how much? Our closing balance is how much? 106,450, right? Are you still coping?
Yes, that's correct.
You want break 106,450. So the 106,450 we minus it. So if we say 106,450 as plus minus, you add 7,500. You add 43.
$31,050.
Okay, I want to verify something. The 106 is the closing balance. So it means it's recommended that we start with, two, 3 minus 1 is T, then the 7,500. Because the trading reserve was 143,000 and now sitting at 106,450 and 106,3,000 we less, and then we minus the 7, then it will be the minus 7950. Then if we say the 7,500 that was accrued to be received in the future, because the amount that we get, it does not correspond with the solution so far, because they used the 106 as the opening balance. They said the 106 minus the 43 plus 7.5. Plus 43 plus 7,500. For the trade receivable at the end of the year, let me do the ledger. Just want to see something first. Balance of the 43,000. Trade receivable 3, and then the closing as balance F sitting 106. Then we had the accrued rentals. So the accrued rental of 7,500.
So isn't that because of it's accrued? We didn't receive it.
Yeah, I'm still trying to check it. 106,450. Then we was not yet receivable. Okay. So it will be like, that's why I want to do it in the form of ledger. So it will be the accrued on this side, because it's not yet received as it's how much? 7.5, ne?
Yes.
Then we have a total of the 106,450 that is not yet received at the end of the year, plus the 7,500 that is still accrued. Then it's sitting at 113,950. Then we say 113,950 minus 43,000, so 79,50. So the 79,50. So if, yeah, now it makes sense. So if, let's say you are doing the calculation and you get confused, try to do it in the form of ledger. You will, at least you'll have an idea of why you were not getting it right. Because this amount, as you said, is not yet received. And also this one is not yet received. So we add them all together because it's the amount that we're going to receive in the future. But this one is already receivable. So now the trade receivable, Yarona, it was sitting at 43,000. Now at the end of the year, it's sitting as 113,950. Did we receive cash or did we not receive cash? Remember, the trade receivable, the more people they owe us, the more we are not receiving cash. The lesser they owe us, the more we receive cash.
We did not receive because we have more.
So we did not receive cash. So we did not receive cash by an amount of how much? 113,950 minus 43,000, which should give us
the one you calculated, 79.50.
79.50. So our 79.50, we didn't receive cash. So it means it's gonna be what? An outflow. Because we didn't receive cash. Okay. Is it making sense? So it means this calculation will be like this. If you correct it from the ledger point of view, it will be like the 106,450 plus the 750, 500 not yet received minus the 43,000 that we had at the beginning. Are we happy with the cash flow of 79.50?
Yeah. Can I ask you a question?
Would you say?
Yeah. Is it possible that we ever, like, I don't know in what scenario, that we'll have the trade and other receivables only negative as a cash flow? Is that ever possible?
The other receivable as negative, meaning negative here or what? Okay,
So
wait, Melissa, oh wait, let me do this. Let me put 79.50. Just leave it like this.
Okay.
Now we go here. We want to ask a question. The balance at the beginning of our trade receivable, it was 43,000, right?
Yeah.
The balance at the end is 106,450, right?
Okay. Yeah.
Out of this 106,50, we discovered that we didn't receive 7.5. It's still being owed to us. So it increases our trade receivable at the end. So now we say the balance that was supposed to be the end plus the amount which is owed by the tenant. Now it gives us the trade receivable at the end of 113,950. Happy, I can.
Yeah.
So the 113,950, that's the amount of trade receivable that we are supposed to get now today, less the trade receivable that we had at the beginning is 43,000. I can.
Yeah.
So 113,950 minus 43,000, it gives us 79.50. I can.
Okay. Yeah.
You still happy there? I can. Up to
Yeah.
so far.
Yeah.
Now we want to know, is the 79.50 minus or plus? Now we're gonna ask the question. Since we have the opening balance as 43,000, now we are having a close balance as 113,950. Did we receive cash or did we not receive cash? Our trade receivable was sitting as 43,000. People, they were owing us 43,000. But now at the end, they owe us 113,950. So it means we didn't receive cash.
Yeah.
I get.
Yeah.
So if we didn't receive cash, it means our cash is now what? Outflow. I get.
Okay.
And when it's outflow, the outflow they are shown at minus here.
Oh. Okay.
Now it's gonna be minus.
Okay. Yeah. Yeah.
Anyone to verify this or to get the clarity on the negative 1795?
You will correct me if I'm wrong. I'm thinking another thing of knowing if it's an increase and decrease. If you start by opening plus adjustment less the close, as long as you remember when you do the adjustment, if it's already received or not. But
okay.
yeah,
On your side, what opening plus adjustment, ne?
Yeah,
Plus
less
the adjustment.
close. On your calculator, get the answer as negative or positive.
Yeah. So whatever amount that you, and again, as she said, remember if it was taken in or not taken in. So the amount that you get as so in this case it was not yet taken in. So it means that amount, the 7.5. If I do look at the opening plus the 7.5, instead you're not over minus, about the 43 minus what then minus that other one. Do we get it? Remember, based on it, who said this statement? The one of the opening plus the adjustment less closing.
Takalani.
Okay, let's follow the Takalani process. We're gonna say opening, which is 43,000, né? And then adjustment. She said we must add adjustment. So by right, it was supposed to be add adjustment. And you add adjustment if it's taken in. If it's not yet taken, so it means it must be minus. So in this case, it will be minus 7,500. And then the closing balance is always minus. So in case the close is how much? Is 106 again. 106. So if you say 43,000 minus 7,500 minus 106,450, it gives you negative 79.50. Are we happy there? Since it's negative, it means it's an outflow. Thank you very much, Takalani. I think the Takalani method will be even simpler. Are we happy? So the most important is to know what's happening here. Is your adjustment taken in or not taken in? If it's taken in, then it will be addition. If it was not taken in, you're minus. In this case, it was not yet taken in, the one of 7,500, because it was not yet included in our closing balance. Are we happy? Glenn?
I'm okay, I understand.
Mary?
I'm okay, sir. Thanks.
Lise?
I'm good, thank you.
And no Kubonga.
I'm okay, thank you.
Okay, then we proceed. Then we have a negative of 79.50. Then we go to the next one, prepaid expenses. So this one, it was an increase in trade receivable because initially trade receivable was 43,000, but it ended up being sitting on 11 something. So we go to the last one. I mean, not the last one though, prepaid expenses. How much was the opening balance of our prepaid expenses? So let's follow the method of Takalani now. Opening of our prepaid expenses.
2,000.
2,000. Adjustment regarding to the prepaid expenses. Is there anything paid in advance by us? Adjustment number 1, nothing. 2, nothing. 3, nothing. 4, nothing. 5, blah, 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 blah. No. 6, the reversal of bonus. No. 7, the issue of ordinary shares and the declaration. No. So it's nothing. So opening plus adjustment. Nil. 0. Then closing balance is how much? Closing
3,000.
Then you say 2,000 plus 0 minus 3,000. Then it will give you 1,000. Eh?
Yes.
Will you say? I think you're no longer gonna struggle with this.
Yeah, so okay, but last question. So if let's say I just say on that increase in prepaid, I just say 2,000 minus 3,000, not the way they have it on the 102 as 3,000 minus 2,000. But if I were to put it 2,000 minus 3,000, it will give me a negative, which is exactly what is required. Will they mark me wrong if I did that?
Yeah. No, it's this method. It's this method. This one. They won't give you wrong.
Yes.
It's like like you follow this principle. You said opening. You said opening plus adjustment less closing. They won't give you wrong. As long as you end up understanding that it's an increase in prepaid. So since it's an increase in prepaid, it's gonna give me an outflow. So increase in prepaid, it give you an outflow.
Okay. All right. Thanks.
And the last one, trade in other payables. Trade in other payables. We had a trade in other payables of how much opening. So this thing, I'm gonna cut them and put them into our calculations. All of them. So our trade in other payables.
212,800.
Opening 212,800. Adjustments. What is the adjustment reflecting trade in other payables?
I think 5.
Adjustment number 5. Let's see adjustment number 5. Adjustment number 5, 12,000. Okay. He received a final demand on 15 February 2012 to pay an amount of 12,000 on or before 31 March. So the 12,000 is not yet paid. So now we have to pay it. So it's gonna be what? We add to a minus. Is it paid yet?
It's not paid. Oh, it need, okay. You receive a final demand to pay an amount of 12,000 before 31 March 2012. Yeah, it's not paid. We're closing our books in February, isn't it? So it's a accrued expense.
Okay, then we said the 12,000 is not yet paid.
Yeah.
So it means since it's still going to be paid, né? So it's still from us part of our payables. We still have to pay it because this was at the end. He received the final demand on 15 February to pay an amount of 12,000 on or before 31 March. So it's not yet paid. We're gonna add it. We happy?
I think we add it to the closing one.
We add it to the closing one.
Yeah.
So it means the closing one of the. Now we remember you're doing the adjustment. So it means you want to add it on the 647,970. Okay. Sharp. Let's leave it like that. Well, let's put it aside. We know it's happening. Then the provision, trade payables at 29 February include the provision of bonus. This bonus, it was included. Now it must be taken out. Because we are reversing it. Akir.
Yes.
So it means all in all on our close. So all these things, they affect our closing balance. So it means our closing balance will be like this. Our closing balance will be the 647,970. We less the 10,000 yellow in, it must be reversed again.
Yes.
And then we add with 12,000 yeah. They want to be paid at the 31 March again. So it means the balance to sit here, it will be what as a closing yarona 647,970 minus 10,000 plus 12,000. It will be 649,970 here. 649,970, and which must be on a minus, because remember the closing balance must be minus. So we say it means it will be the 212,800 minus 649,970. Then we have the 170. But the 170 is sitting, according to the calculation, is sitting at minus, right, Takalani?
Yes. Yeah.
Now, question is, since our trade in other payables, it was now sitting at 21,800, but now at the end of the day, sitting at 649,000. Did we pay people or did we not pay?
We did not pay, so we've got cash.
We've got cash inflow. So at the end, you just have to ask this question at the end. Okay, my opening was this, my close is now this. As a result of this movement, did I pay people? Did I not pay? Did I receive cash? Did I not receive cash? So in this case, we didn't pay people. So if we didn't pay people, it means the cash was not going out. And if the cash is not going out, it means we have a cash inflow. So now the 437,170, it will be an inflow here. So it will be an inflow of 437,170. So, but it was an increase in trade and other payables. So if the trade and other payable increase, they generate an inflow because we are not paying people. So all this, they're gonna sit in one box. Then we say this plus this minus this minus this plus this. So they can give us a value here. Let's calculate this value so that we can see if it's an inflow or an outflow. Someone do calculation for me.
393,220.
393,220. It's a positive figure, ne?
Yes, it's positive.
Okay. So are we happy up to so far with this indirect method?
Can I please ask on the calculations of trade and payables?
Here, you want this part?
Yes, I want to confirm, is the 10,000 the bonus pay?
What's happening with it?
This 10,000 that you're lessing here, is it the bonus pay on the adjustment?
Yes, is that one, because now because it was supposed to be payable at the end of the year, but because we are reversed, we have to, because it was already made. Remember, the statement said it was already made as a provision. They said, listen to the statement, trade payable at 29 February 2012, meaning this amount, yeah, 647,970, ne?
Yes.
Included a provision of a bonus of 10,000 for space out, which the directors decided to reverse. Okay. They informed Mr. Space. They informed Mr. Space out on his appraisal on 1 February 2012, but he has not processed this adjustment. Now we have to process this adjustment. Yeah, reversal, yeah, bonus, yeah. It was already included. Now we have to reverse it because he did not reverse it yet.
All right. Thank you, Minnie.
Okay.
And if you want to maintain that other example, that other calculation, we can put 10,000 and 12,000 there under adjustment. And
yes.
then we leave
they
at 647.
They will take different signs though. So we're gonna, if we maintain the same calculation, we'll say opening is 212,800. And then on the adjustment, we're gonna put the 10,000, which instead it's gonna, because this 10,000 was already, it must be included on the opening balance. Okay. And then the lessening of the 12,000. Because they have to take different signs. And then this one will be minus minus what? 647, 970. Let's see. Are we getting it? It's only the manipulation of the signs. I mean, but you have to know the reason why are you manipulating them. The reason now we manipulate the sign, listen, this as a reversal, we reverse it by putting it inside the opening balance. So we reverse it on the opening balance. Because it was already included on the closing, which must be paid out. So now we have to reverse it in the opening balance. And then again, the 12,000, which was supposed to be, the 12,000 is going again. Yeah. 12,000, yeah.
Accrued expense.
The accrued expenses. So the accrued expenses based on the amount to be paid for the fine. Because this is the fine kind of. The amount to be paid for the fine must also be, because it was going to be addition on our closing balance because we have to pay it 31 March. So we put it as a minus on the opening balance. So if you want to maintain the system, yeah, opening plus adjustment less closing, then you have to make sure that your adjustment, as Takalani said, you have to check whether is it included or is not included so that you take the right side. We're happy there. So you can just play around like based on the one which you understand mostly. So now we're gonna go to the net cash from operation. So what we calculated here, we kept the 393. So we're gonna add the 2. We added the 212 and the 393 so that they can give us the net cash from operations. So when we add them together, they give an amount of how much? 393 plus 212, 500.
605,720.
So this will be net cash from operations. Now we can do other things which they affect this, which will be the investment income. So it's like now you a little bit reversing. You're gonna do the investment income, the finance charges, the dividend paid, the normal tax paid, the purchases of the fair value things. So now we have income from investment. Investment ja rona ke bokae? The income from investment was shown at
15,000.
15,000, and then And then when we go to $5.2. So the income from investment, it will come as a fund of, it will be the dividend we receive from other people. So you have the 15,000 as the one from the statement of profit and loss. You have the 5.2 from the dividend receivable, and you also have the 2,000 for last year on the dividend receivable on the statement of financial position. Do you see those amounts? The 5.2, the 5.2, the 2,000, the 15,000. Yeah, they want to be used there. So the income from investment, we're gonna take our statement of profit and loss. They're 15,000. Ne? Then we less the 5.2, the closing balance. We less the closing balance, we add the opening. So it's like opening minus closing and then minus the adjustment. So the one happened during the year in the statement of profit and loss, it will be the adjustment. So you just follow the same pattern. Yeah, takalan. Yeah, opening. So the opening, it will be how much? It's 2,000. The adjustment is the 15,000. The closing is 5.2. So the 2,000 plus 15,000 minus 5.2. You give an amount of how much? 11,800. So we are using the same formula, yeah, takalan, yeah, opening plus adjustment less closing. Adjustment comes from the statement of profit and loss. SPL. We are happy. Hello.
Yes.
So our 11,800, it's gonna form part of the income from investment as a positive. So we say income from investment is 11,800, shown as on our calculation. Then finance charges. Our finance charges, we use the same format. And this one was investment and income. And then the finance charges, same format. Finance charges. Then we're gonna have opening. You have opening over the finance charges.
$1,200.
The 1,200 from the accrued interest long-term borrowings. 1,200. And then the adjustment. Adjustment come from the SPL. $72. Okay. The 72,125. We're all happy then, right? Then less the closing. The closing will be 67.30. Okay. Let's calculate. So our finance charges 1.2, and then the adjustment during the year. Yeah, 66595. So, but I want to do the inflow and the outflow side. Because they say it's accrued, né? The accrued means they are not yet paid again. The accrued opening was this, then we paid this. The accrued closing was this. So it's an outflow of the finance charges because we paid much than the accrued that we have. Because this is what we is this. Because it's like we paid this out of this. This is the one which is still outstanding. Is it clear?
Yes.
Okay, so we're gonna put this an outflow of 66,595. 66,595 will be an outflow. And then we have dividends paid. The dividends paid, they will also use the same format. So the dividend payable at the beginning of the year is how much? This one is gonna be a little bit complex. Dividend payable
15,000.
15,000. Okay, sorry, dividend. I'm gonna say dividend and then dividend payable. Dividend payable beginning 15,000. And then during the year, the dividend paid against profit. So dividend paid against profit. Interim. Statement number
7.
7. But is the interim dividends of how much? The 200,000 ordinary shares paid at what cents?
10 cents per share.
Which is 20,000, ne? Again. 200,000 multiplied by 0.10. It will be 20,000. You happy? And then read the statement further. They say further than what's an interim ordinary dividend of 10 cents per share was paid on 31 August when there were 200,000 ordinary shares in issue. Sharp. On 31, further 50,000 shares were issued. Sharp. But Mr. Spacer didn't record them in the revenue account. We have corrected them. Now they are in the share capital. So it means the final dividend, how many shares do we have now?
We have 250. 200 at the beginning plus the 50 that was issued, which is 250.
Yeah, so it's 250. So the 250 will be declared at what rate? At what cents? Read the statement further. In the view of the anticipated decrease in the forecast profits, the director decided to reduce the final dividend per share by 60%. The final dividend per share was 10 cents. Now they decrease it by 60%. So if you say 100 minus 60, we are left with 40. So the 40% divided by 100 multiplied by 10 cents, we left with how much? 4 cents, then.
Yes.
Are we following the calculation? Yeah, 4 cents. Here I'm gonna check one by one.
Yeah, it's now 8,000 now that we're using the 4%.
Okay, Glenn. Glenn.
Yes, Mania.
You are following the calculation of 4%.
Yes, I do.
Mary.
No, sir, it's a bit confusing.
Okay. 10 declaration of dividends. Is sitting at 10 cents a share. So now that was the interim. And now on the final, it's not the interim. Then on the final, they say that dividend need to be reduced by 10 cents. I mean, by 60%.
So 10 cent happened then. So now this is a new declarance.
Yes, 10 cents had happened. I got the 10 cent.
Okay, okay.
Now
So
the final, we are doing the final
the
one.
4% will be on the 250 shares.
Sorry. Hey, we are
I'm
on the
saying
200. We are now on 250 shares because there were 200 shares issued plus the 50,000 shares issued on 31 January. Then it will be 250 shares. So now it will be 250 shares multiplied by. Now we want to know the value.
All right.
So the price, it was 10 cents. I agree, or it was 0.10. Okay. Now there is a reduction of 60%. So 100% minus 60%, it's gonna give us the 40% like remaining. Like, so it means now this must be deducted by 60%. So 60%, yeah, 10 cents. Okay.
4 cents. Or the 60% is 6 cents. Then the remaining will be 4 cents.
So now we must minus 0.06 cents. Okay. So the final one, final amount, it will be 10 cents minus 6 cents. We are remaining with 4 cents. Okay. We are happy.
Yes.
So this 4 cents is the one to be used to calculate the dividend here. So we're gonna say multiply by 0.04.
10,000.
Multiply by 0.04. So it's 10,000. So we are happy, I get.
Yes.
So now the unpaid amount at the end of the year is from the statement of financial position, dividend payable. Paid amount at end is how much? Statement of financial position, paid amount at the end of the year. Dividend payable, 20,000.
45,000.
45,000 from
30,000.
where?
Oh, I was including the opening. Sorry, it's 30,000. The 20 and the 10.
The 20 and the 10. So it's the yellow and the blue.
Yes.
The yellow and the blue, they are paid. Dividend paid, I guess, profit 10,000. Final dividend paid 10,000.
Yeah, okay.
I want the amount which is unpaid. The one who is still sitting as dividend payable in the statement of financial position. Okay. Check your credit side of the SFP. Dividend payable at the end of the year.
20,000.
Now we follow the rule here at Takalani. Opening plus adjustment less closing.
Yes.
Okay. Let's follow the
Yeah,
rule.
I was telling you the total adjustment for the year, like the adjustment, like when I was saying 30,000. I thought we
Okay.
total declaration for the year.
Yeah, this is the total adjustment. It's fine, no problem. Then the balancing here, 15,000 plus 20 plus 10 minus 20, it gives us 25,000. This will be our dividend at the end of dividend paid, which will be the 25,000. So the 25,000 will represent an
Cash outflow.
Cash outflow. You all happy? So now we go to the income tax page. This one is just a simple income tax page. Our income tax page, it will be the income tax page, it will be opening. Opening income tax. Go to the statement of financial position.
Opening is 20,000.
Opening is 20,000. You all follow it. The one for tax something payable by SARS. Then adjustment is the one from the statement of financial position. I mean, statement of profit and loss. Tax paid, income tax expense. Okay. The 18,725. We all happy, ne?
Yes.
Then the closing. The closing is the tax payable SARS 31,000. And we follow the principle at Takalani. Opening plus adjustment less closing, it gives us the amount of 7,725. So our 7,725, our tax at the beginning was this. Now the tax at the end is sitting as this. So it means we did, the tax at the beginning was the 20, now is 31. So it means we didn't pay much of tax. So it's gonna give us which flow, the method, 7,725 here to be
Inflow.
It will be?
We didn't pay much on it. So it's not cash outflow.
It's not cash outflow, so it's cash inflow. Okay, check that the tax paid part. The tax paid last year, we paid 1080 in terms of tax expense. We paid 10,802. Now we are paying 18,725. We are paying more. From the statement of profit and loss, we are paying too much tax. So it's an outflow of 7,725.
Oh, yeah. The opening is bigger than the closing.
Okay, and then the last one. They see the financial asset purchased something. The financial asset at fair value through profit and loss. In the initially was 153, now it's sitting at 180. So it means we bought more shares for selling purposes. So it will be the financial asset. You see that this one is not even in the adjustment. It's just they want to show the purchases. Because remember, there is a last statement which they mentioned. Check adjustment number 8. Adjustment number 8. The company financial assets are held for trading. So it means we purchase financial assets in order to sell them. So this will be regarded as our operation. But in Kabebari, the financial assets are held for investing. So it means the increase in the financial asset was not going to go under operation. It means instead it was going to go under the investment. Did you see that statement? It can trigger everything. It can change everything. The amount that you're going to record as the gain in financial assets, if the statement was say it is for investing purposes, it was going to go under the cash flow from investing activities instead of going under cash flow from operating. So the reason it go under cash flow of operating is because the business model of this entity is to purchase investment and sell them. So it's their operation. Is it clear?
Yes.
Yes.
Financial asset. So these financial assets, they are for operation purposes. Operation purposes. Hence, it's for trading. It will be, in the beginning, it was how much? Financial asset in the SFP, it was 153 acre.
Yes.
Financial asset in the beginning, opening 153. You don't have adjustment. They didn't purchase any investment during the year. Nil. Using sitting at 180. So 153 minus not, 153 plus 0, then minus 180 is sitting at how much? 27,700. Akir? Are we in the same page?
Yes, it's correct answer.
So now, because this was for operating purposes, we're gonna record it here as the 27,700 outflow, because initially we had 153, but now we have a 108. So it means we purchased more of the investment, but we're not selling them. But in the opening 108 and at the close it was 153. So it means there were more investment purchased during the year. As a result of that, then it's gonna regard as an what? Suppose this balance were twisted. 108 was sitting here, 108, and then the 153 was sitting here. How are we gonna record this investment? It means we didn't sell much of the investment. So since we didn't sell them, sorry, I'm listening.
You can continue to finish your question.
Or I was saying, since at the opening balance was 108 and at the end is 153. So there were not much of investment sold. So it means since no investment sold, so for our financial asset in terms of operation, we didn't sell them. So they are still sitting in with us. There's the result and outflow purposes. Because the purpose is to sell.
And in this case, maybe we bought more because we're from 108 to 153.
Yes, we bought more. It says in cash outflow. But there's one thing that I want to follow here. In the beginning, it's 153. At the end, is 180. So this one they purchased more because now they are closing. at 18700. So there are more investment purchased, but they were not sold. That's why it's an outflow here of how much? 22,700. Because the opening is 153, the closing is 180. So it's an outflow. Please say, are you still following?
Yes, I'm following. Thank you.
Okay. So that is your cash operating activities from the indirect method. So now you're gonna say this, you add whatever need to be added, you subtract whatever needs to be subtracted, then the amount that you're gonna get, it will sit to this side as your cash from operating activities. So the cash from operating activities, if you say 605 plus this, minus this, minus this, plus minus this, minus this, it's gonna give us the 490,500. So with this will be cash, it will be net cash inflow. This is an inflow.
Can I ask a question? In a case where the company that we invested on, maybe they declared dividends, but they said not in cash, instead of they'll just like give us more shares, and then that increases our investment. So like we didn't like from 153 to 180, we didn't spend like that 27 to buy more investment, but we got to 180 because of they've increased our shares. So what do we do in that case? What do we say?
Now it's gonna go to your investment part, because you didn't buy them, they give you them in the form of profit. So it means you are now having proceeds on investment. So it means you are on the investing item, in the investing operation, you'll have proceeds in investment of shares, proceeds on there, because there are more shares issued as part of investment. Even actually, they will affect the financing part. You have the proceeds on shares issued in the form of investment. The 150, how much? The 153 minus 108, but it's going to affect your financing, because they made the investment in the form of the dividends that they declared, but not in the form of cash, but in the form of shares. Makes sense? It will be the cash in the form of, because those dividends, they are now form part of the finances. You have finance for your share capital. Is it clear?
No, I want to know, how do we acknowledge it now on the cash flow? Because of years we didn't.
That's why I say on the cash flow, it will be acknowledged under the cash flow from financing activities as proceeds on issue of shares.
All right.
It will be the proceeds of issue of shares.
All right, thank you.
Okay. Another question? So the last part that needs to be done is the financing, the investment. So the investment is gonna also follow this. You remember the journal, this calculation that we did, this one, it's gonna involve more of this information. So let's do this. You have your solution on the tutorial letter, ne?
Yes.
Go to your solution under the investing activities on page what? 148. Yeah. Because time is already gone. We are already above our recording thing. Because it's just 2 hours now. We are approaching the 3rd hour. Are you in page 148?
Yes.
Okay. On page 148, we've got replacement of property, plant, and equipment. 115. They say is given. Is that amount shown in the SF? It's shown in the adjustment number 3. That 115 is the replacement is given. It's just one mark the way it is. And then the investment in the extraction of the property. They say it's calculation for the land. So the land will be, if you go to the land and building, they have the balance brought down on page 149. You have balance brought down of 300,000. That comes from the PPE. The land and building on the SFP, you have balance brought down of 300,000, which is goes, you take the debit side, and then you have the revaluation of land. The revaluation of land was given as information on revaluation surplus of land is 50,000. Do you see it? You put it on the credit side, on the debit side, because increasing our land and building. So the balance carried down of 1.2 is the closing balance. So 300 plus 50 to be 350. So 1.2 minus the 350, they will give you 850. So the 850 will be your addition. That's why you're gonna record them there as your addition on the land and building is 850,000. Is it clear? That was just a simple calculation. Takalani?
Yes, it's clear.
Maelo? Mary?
Yes, sir.
Nukubonga?
Yes, it's clear. Thank you.
Say.
Yes, clear, thank you.
And then lastly, Glen Rose.
Yes, Meneer, I understand it.
Okay. The addition to plant and equipment is the one we calculated. If you can check this yellow, the 343 is this one. Happy?
Yes.
Okay. Then it means the
Yes,
850,
yes.
the 850 and the 343, they result in a cash outflow on the investment capacity of 1,193,000. Then the proceeds from the sale of plant and equipment, those are the one which we did. As per here, you see the proceed from the sale, the 30,000 given is the one which was on for machine number 1. It was sold for 30,000, and then the machine number 2 was sold for 19,200, which is the one we calculated on. Where is it? The one we're doing with, it should be here. Some sale, cash net. The other number 2 was total loss. Just hold on. The machine number 2, we said the sales should be how much? We calculate it some way.
Machine number 2, the proceeds, we said it's 19,200. We had to work backwards because it was not given. The amount that we calculated was the loss, and then we worked backwards. Remember, we got accumulated depreciation?
Yes.
Yes.
Yeah, that will be that 19,200. So the 19,200 for the machine 2. So you add it with the one for machine 1, the proceeds on, say, the proceeds on machine 1 plus the proceeds on machine 2, then they give you the total proceeds. We happy up to so far?
Good.
Okay. Then that was the required part. The last one, it was not required. They just did it for completion purposes. So the proceeds on the shares of issued is the 200 shares issued at the beginning minus the 50,000. There were 50,000 shares issued during the year. This is the proceeds on sale of the issue of shares. Then the proceeds on the long-term borrowing, they said it's 712,500 plus 237. The 712,500, it came from the long-term borrowings, where 1 year 7% long-term borrowing is 712,500. And then the 237, it came as a result of the short-term portion of the long-term borrowings. If you see it will be the 712,500 plus the 237,500 to give us the total of 950. Then the debenture of 100,000, they came as a result of the 12% debenture of 200,000 issued. So we have the opening balance, we didn't have the closing part. So it's the redemption, because they said the debenture will be redeemed. There was some information on adjustment number 2. The debenture was also redeemed at par on 30 June. So that's the redemption. There were debentures issued at the 100 at 2 rand each, the 12% debenture at 200 each, so it's 100,000. So they have 100,000 now, they are redeeming it. So when they redeem it, it will be the 100,000. It's clear, right? Are we happy? Silence.
Yes, yeah, we are happy.
Then the last one will be the repayment of long-term borrowings. So that was the end of the question, the one we did. Any other additional information? The question 20, what was 21? It was just the normal consolidations. So I wanted to cover this part of cash flow because people, they were struggling with cash flow. Because the consolidation, we've been doing them from day 1 until last week, kind of. Any question? Any question? Glenn?
No question, Menir. Thank you.
Takalani?
No question.
Mary?
No question.
Mudise?
No question, thank you.
And lastly, Nokubonga.
No question, thank you.
So we are ready for the exam Tuesday.
Yes. Just we still
Okay.
have a day tomorrow to polish.
Make sure tomorrow you polish whatever you need to be polished. The WhatsApp will also be available. WhatsApp, whatever you want to ask, it will be answered. There was someone who posed the question. I'm still going to check that question. The one which was somewhere in exam of the prior year. I'm still going to check that question and then I will revert back to you.
Thank you very much, Menir. We appreciate your assistance. Good luck to everyone.
Good luck to you, and I don't want to see you again next year, all of you.
Thank you. Thank you.
I'm closing the door now and I'm locking it. You are now outside. If you knock in again, I'm not gonna open. I'll open for other people, not you.
No, we'll do our best, Menir.
Okay, thank you very much.
Thank you.
Thank you. Thank
luck,
you.
everyone.
Thanks. Good luck,
Likewise.
guys.
Bye.
Bye. Bye.
Greg. I don't know if